Hi, everyone. Thank you for joining us for today's webcast, What is Life After Coronavirus? Working through the PPP Loan Forgiveness Application, presented by Rea Associates, a top 100 regional CPA business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will be working to respond to as many questions during today's presentation as possible. Any questions we did not answer during the webcast, please reach out to us at raynews@raycpa.com, and we will respond to your email at the conclusion of today's presentation. If you are registered for today's webcast, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics related to the COVID-19 crisis. Also, if you'd like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webcast will be given by Doug Houser and Paul McEwan. Paul McEwan is a principal at Rea Associates, where he leads the firm's retirement plan consulting and administration services team. He is responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. As a principal and director of construction and real estate services at Rea Associates, Doug Houser is committed to building out and growing the construction and real estate services segment while continuing to ensure that we are known industry-wide. Today, Doug and Paul will discuss how to navigate the PPP Loan Forgiveness Application and risk mitigation and more amid the COVID-19 crisis. And take it away, Doug.
Thank you very much, Imani. And Paul and I were joking actually beforehand today that we should start calling these Stump the Chumps. So in all seriousness, though, I know it is a serious topic, and we do want to certainly spend some time on the application for forgiveness today. We are not going to go through that application line by line, however, but if you do have that available to you, I might suggest that you pull it up side by side, or if you have another screen available, just so if you do have any issues that come up, we will certainly try to address all of those in Q&A, but we want to make this a back and forth session. We're going to have some poll questions today as well, and Paul and I will give our perspective on what we see here. So with that, I think we'll get started. The application itself, Paul, you want to give some background in terms of where we are at today?
Sure. First of all, we've gotten a lot of really positive feedback, and so from my perspective, I just wanted to let everybody know how grateful we are that you've been tuning in, following us along. We're going to see this thing all the way through, Doug and I, so keep coming back. I'm sure this probably won't be the last show that we do. So on the first slide, we just really wanted to give you, kind of let you know where we left off. So our last webcast was on May 14th. So May 18th is come and gone. That was the last day to return your money if you decided you didn't have the stomach for all the chaos. But hopefully those that have decided to hang on to the money will be rewarded in the end. I think we did get a lot of clarity regarding that necessity certification after our last webcast, actually. And so, just some things that have transpired since then. On May 15th, they came out with the actual loan forgiveness application and the instructions. And then there was more guidance that was on several key issues that was released. And then on last Friday after business hours, of course, more guidance in the form of 2 interim final rules, one on loan forgiveness and one on SBA loan review procedures. But still no deadline for application. We keep getting that question. We get it a lot, but no deadline. I think, Doug, you had mentioned that some banks, some lenders had proposed some deadlines, but nothing.
Yeah, I have seen loan documents for a number of companies, and there are a few banks that do have a 30-day post cover period deadline. Now, so you want to go back and check your bank documents specific to the PPP loan, because Most of them are silent, but there are a few that have 30-day deadlines. I would suggest if that is the case for you, go to your bank and ask for an extension. I'm sure they'll give it to you. I know there is a 60-day deadline for them once they receive the application to submit it to the SBA. But of course, this will all change on some Friday night news dump, as Paul alluded to, which they seem to be very fond of. But yeah, check your loan documents for that, just to make sure if you do have a 30-day deadline, you can deal with it. Boy, we've been hearing a lot of stuff here, haven't we, Paul? I mean, goodness, who knows where this is going to land.
Yep. We want to make sure we address this right up front. I was on a town hall call with the AICPA last week. I think it was Thursday. They were quite adamant that there was some proposed legislation that I've got summarized here that was a near certainty to happen. They wouldn't obviously guarantee it, but we do think we're going to get within 2 to 3 weeks. Again, the Memorial Day holiday is playing a little bit of havoc with the calendars at the House and at the Senate, but within 2 to 3 weeks, we think we're going to get some legislation that it doesn't look like there'll be any resistance from the president on signing any of this stuff. So we think once it gets passed, it will flow through pretty quickly. So we do expect to get an extension of the 8-week measurement period. We don't know what that'll be at this point, but we think it'll be at least a 4-week extension. It might be 8 for a total of 24, but we don't know.
Well, I've heard 16 to 24 total.
Yeah, that's what I mean. An extension of either 4 or 8 to get to 16 to 24. Yeah, sorry, I should have explained. And then the other thing is the relaxation of the 75% payroll cost requirement. We're sure we're going to get a relaxation of that. We don't know, is it going to be 50%? Is it going to be something less than that? Something more than 50? So we don't really have anything else to tell you other than I think there is going to be some relief out there that we're pretty sure you can depend on that.
Yeah.
And then also, I think a high likelihood that the forgiveness related costs that currently would not be deductible because the loan forgiveness would not be taxable. So that's that Internal Revenue Code section 265 that basically says any costs associated with tax exempt income isn't deductible, will be changed with legislation such that you will be able to deduct that. Any other comments on that?
Yeah, I was on a call last week with a prominent law firm that's closely tied into the legal lobby, and they said same thing. This is a done deal in some fashion because this has been pulled out of what was the HEROES Act that was proposed by the House. So these are specific things that have been pulled out that have bipartisan support. This will get a done deal. I guess the only question I have on this one is the deductibility of the forgiveness related costs. There's been some uproar about that. As it stands now, as Paul said, it's tax neutral. It's not like it's a bad thing, but there's a significant cost to this one. If you think about just conservative, I know there's already $500 billion that has been lent through the PPP. If you just conservatively assume maybe a 30% tax rate, you're talking $150 billion cost there. So this one ain't free. It'll be interesting to see if there's some horse trading that goes on to quote unquote pay for this. Haven't heard that yet, but we'll see.
Yeah, and the only thing I would say to kind of finish this discussion is I have heard this is a bipartisan issue. So there's Republicans and Democrats that both insist that when the CARES Act was written, that this was intended, that it would be the tax benefit that that there would be a deduction of those expenses such that there would be a tax benefit flowing through to any businesses that use the loan proceeds in the way that they were intended.
Yeah, and the 8-week measurement period being extended, that's obviously of great benefit to a lot of service-related businesses and industry, the restaurant industry who's struggled. All right. Documentation requirements. So this is what was contained in the interim final rule that was part of the dump last Friday, as Paul suggested. So I think the key things to focus on here are treat it like any bank loan or bank loan file. You've got to give all the required stuff. Now, hopefully, you're working with a good lender that will sort of help you through this process in terms of checking those boxes to make sure that you've got it all there. And it's incumbent upon them to do so. It is one of their requirements, as well as certifying your calculations. So we're going to get into this later, but I do know that all the banking industry and the banks as a whole are working on an online submission, because if you think about it from their perspective, they don't want to certify or recalculate this forgiveness application on their own. So if it's in a software type of environment that's automatically done where you input that information, so much the better. I think the document submission that goes along with that will be trickier, but I think they will get that figured out. So it is much more of an automated process, we hope. And that's what we're hearing, that those programs are very close to being done and rolled out. I'm sure the bankers out there are well aware of that. But you got any other comments there, Paul?
Yeah, the only thing I would add is we've got a long list of things that need to be attached as supporting documentation. We'll go through those in some level of detail, because it is important that you get those attached or submitted as part of the process. It isn't just the two forms down at the bottom, the PPP loan forgiveness calculation and Schedule A. There's a Schedule A worksheet that's out there that, well, you don't need to submit it. You need to have in your records, certainly. But there are some other things that do need to be submitted along with the two things at the bottom of this slide. And we'll go through those. And then there's another level, as I mentioned before, kind of the Schedule A worksheet, as well as other supporting documentation that are going to go towards supporting a lot of other assertions that you have to certify when you file for forgiveness. And so we'll step through some of that stuff too. It's stuff that's maybe a little less obvious, but it's stuff that we've talked about in the past already. It's nothing new, but just a reminder for you.
It's certainly a lot of documentation, and I think as we've said before, we want to tell folks it's best to think of this as if you're building an audit file. I mean, it's got to be very substantive, and a lot of stuff will be should be in there. Not certainly required, but we think best practice, and we'll go through some of that as we get further into the presentation today. So, first poll question. This one is really near and dear to our heart. Paul, you've got, I know you've got some comments you want to make on this question. We'll let folks answer.
Well, yeah, I just wanted to put this one in perspective. And so we've already had a lot of clients asking us, hey, would you prepare this application for me so that I can then submit it to my bank and know that it's been done correctly, and so that I can make sure that I get my forgiveness. And so obviously, being as service oriented as we are, we want to be as useful to our clients as we possibly can. And if we're going to do it, we want to do it right. So that we've got to build out a process to do it, and that takes resources, human resources at the firm. And so we're just trying to figure out what kind of demand is out there for what we'll call a white glove service, in terms of building up the application and all the supporting documentation. So I'm sure many out there will feel like, hey, with a little bit of guidance, attending a webcast, I can probably put this thing together on my own. All the way to the other end of the spectrum, where it's, I'm not a detail-oriented person, and I want to make sure I don't mess up this forgiveness piece, and I'm going to have somebody else do this, just in the same way that I would have somebody help me with my tax return, because it is a little bit of a complicated application.
Right, and I would tell you certainly the bulk of. Go ahead, Amani.
The results to your poll is 54% say a little bit of help would be nice. 17% said no help needed. 20% say they need a lot of help and guidance, while 9% say they would like complete total support.
Okay. So the bulk of so correct me if I'm wrong here, but we've got over 90% either say what they want is some consultation, and this is, it kind of falls in line with what we've been seeing so far, right, Paul? You know, most of the
Yes.
folks we talk to, either clients, prospects, or other centers of influence, you know, they want help with a few questions here and there, some guidance, some clarity. Not that we have all the answers, but I think, you know, everything's a sliding scale of risk, and we sort of point out where those areas are and try to give some clarity. But I'm a little surprised it's not higher. Only 9% just say, hey, I don't want anything to do with this. You guys take care of it. Right?
Well, and I think, yeah, that was our expectation, was that we're probably hearing the squeaky mice, the clients that need a lot of hand holding and a lot of help.
Yeah.
They're the ones that are talking to us. And so we didn't want to overreact, I think, in terms of figuring out how many people we were going to need to put on this project.
Yeah.
So this is very helpful. We thought we had the perfect audience to ask this question. So this is great feedback for us.
That's helpful. So let's get into some of the documentation requirements. You know, we don't want to spend a ton of time on this stuff because you all can certainly read this in the application yourself. But just as a reminder, these are some of the things that you need to start pulling together and compiling. And if you start to look at this stuff, you know, it gets pretty voluminous pretty quickly. More is better. I will tell you, having spent years in banking myself, if you treat this like a loan review, which is what we used to call, you know, the internal auditors before the OCC would come in, you've got to have a lot of stuff here. And whether or not they look at it all, if you ever get audited, that's not really the point. The point is you need to have all this stuff ready and there and available. And the banks are supposed to check that you have submitted all the proper documentation as is required with this forgiveness application. So again, more is better with regard to this stuff. Any other comments to add on that one, Paul?
No, we pulled this straight from the instructions. Everybody can read, so we don't need to belabor this.
Same thing here. You want to go over this at all, Paul, a little bit, or what are your thoughts here? Nothing new here, really.
No, we have had. This is just more the documentation requirements. So you're going to have a lot of different measurement periods here, I guess, is the point with this. So you're going to have your average number of FTEs on payroll per month in 19, or in the first 2 months of 2020, depending on which reference period you select. And then it could be, if you're a seasonal employer, you pick yet another reference period to compare to the 8-week measurement period. So you're going to have FTE documentation showing all of that. So I think that's the only point.
Non-payroll, you know, a number of things here. You know, make sure you've got your documentation in order, because, you know, unlike the payroll stuff, this can be different, particularly when you get into all the utility and the rent or lease payments and all those things. And you want to make sure you got your proper documentation. All the stuff is signed and dated. Anybody who's been through any kind of loan review, or for the bankers out there that have seen how they review these files, signing and dating is a big thing. So just because documents are in there, make sure they're all signed and dated where appropriate.
Yep, I don't have anything to add.
Here's some of the supplemental stuff, Paul. You wanna go over some of this? Not required, but certainly must have.
Right, and I think this just goes to documenting not necessarily stuff within the application, although some of it does have to do with that, but it also goes to documenting the necessity as well. So this is the PPP Schedule A worksheet. Obviously, you're going to want to have that. Now, in addition to that Schedule A worksheet, not only will you, and just kind of thinking through the application itself at this point, you know, when you fill out that worksheet, at first appearances, it looks like, well, you just have to fill that out for the covered period for your 8-week measurement period. But obviously, you're going to have to fill that out for your reference periods also. So that right. You'll probably have more than one worksheet there. And obviously, the more employees that you have, the bigger that's going to get, and you're probably going to have an Excel spreadsheet.
Yeah, I know a lot of the large payroll providers out there have already developed customized reports available for their clients that use them. So certainly many of you out there are already checking on that, but where you can do that to help with this process certainly makes it much easier. But still, it's a lot of information, as Paul said, for each and every employee.
Right. Yeah, I don't really, I mean, everybody can read what we've got there, so I don't really have to spend any time on this stuff.
Key part will be that second to last one there, voluntary resignations and folks that should be excluded from the calculations. Make sure that's documented.
Yeah, again, it doesn't have to be included, but you've got to have it if you're asked for it.
A lot of stuff here. Again, some of these are our suggestions with regard to, again, the thought process of building that audit file. Go back to your thought process when you applied for the loan. So many unknowns, all the conversations you had, as we indicate on here, management meeting minutes, emails that you had exchanged among your folks within your company talking about, the thought process, where are we at? Again, make sure those kinds of things are signed and dated. Reflect on what you thought was your budget for the year going into that period, and then your budget after that. And, if you haven't already done that, make sure that you do and reflect the change in thought, the change in the market conditions, all those things. Prepare a rolling cash flow that you had, even if you haven't seen significant impact yet to your business. The whole point is you didn't know at the time, and you can play around with some different modeling there. I think all of that goes to thought process and is very, very important to have in the file for down the line. I think those certifications and the whole thought process is very important.
Yep, the guidance that came out last Friday with respect to the SBA loan review process was, I think, pretty illuminating, and it made it clear that if they choose you to be audited, and I don't know how SBA is going to do it. I don't know even if they're going to do it, if they have the manpower to do it. But if they do, they can look at pretty much everything from the beginning of the loan process all the way through to the end of the loan forgiveness process and everything in between. So the bigger your file, the better. And in terms of the necessity certification, like you were saying, the more you have in the file in terms of your thought process, the better.
And the other thing I want to remind people to think of this as a living file. It's not just, okay, I'm going to prepare this forgiveness application. I'm going to put all this information together, and then I'm going to throw it on the shelf for, 3, 4, 5 years. They can still come back to you. Continue to write those memos to the file maybe every 6 months or 12 months that you as a management team went back, looked at the file, reviewed it, made sure that you documented things that happened, because there will be impact for many years down the road, stuff that we're not even contemplating today. But I think it's important to say, you as a management team or as a board or an advisory board or whatever, hey, yeah, we pulled this file back out. We went back, looked at it for appropriateness, made sure we had stuff that, nothing was missing. And, here's another memo to the file. Treat it as that living file, because I'll remind folks, the Inspector General related to TARP is still active today, 12 years after the fact. They're saying 6 years for this, but, be prepared. And the other thing, there was a lot of this discussion early on, well, if I'm over 2 million, then I've got a little bit more to worry about. They say all of those will be looked at. Just because you're under 2 million doesn't mean your file won't be picked as well. So keep that in mind. Second poll question. Paul, you want to take this one?
Sure. So I'll read the question. Are you still anxious or concerned about the necessity certification when you applied for the loan? Now I can't see the slide. There was some other language on there, but it doesn't matter. I think what we were getting at is, I'm just wondering in the audience, how many, even though we've gotten some reassurances that if you're under 2 million, it's your de facto necessary, what percentage of you are still really concerned about this? Hopefully the anxiety around this issue has gone down. And certainly if you document your need, all the better. That's really all we were.
And again, when they came out, as you said, and said, well, the worst thing that's going to happen to you is you gotta pay it back. So
it looks like 32% said yes and 68% said no.
Good.
So that's, yeah, as you said, Paul, yeah, that's definitely lower than what it was previously.
Yes, there was definitely a lot of concern out there before we got those FAQs.
Yeah.
That's good. But it's still interesting to note that there's a ton of money, over $100 billion, that hasn't been lent out yet. I think SBA really threw a lot of cold water on the whole program, unfortunately. And,
yeah.
It's employees that'll end up suffering as a result.
Well, and again, I would, remind everybody, just don't be a bad actor here. I mean, there's positions you can take, and again, there's kind of a sliding scale of risk with some of them, and talk to your advisors, document. As long as you're adhering to the spirit of the program, you're not going to have any major problems. I mean, they really want the low-hanging fruit when it comes to this stuff. By that, I mean the fraudsters out there. So I would, reassure folks, don't be overly concerned. Paul, you want to talk about this? I know you've done a deep dive into this part of it here.
Here, I think before we get into the actual application, we wanted to just review a couple of different topics. One is the covered period. So specifically for payroll costs, we found out in the instructions and in the guidance that came out Friday, a little bit, well, there was an additional alternative, what they're calling an alternative payroll covered period. That is really designed to make it easier for you as an employer to provide documentation that syncs up with your numbers. And so depending on which period you pick, you can stick with your original measurement period that starts on the date of your loan, or you can go to this alternative payroll covered period beginning on the first day of your first payroll period after you receive the loan funds. I guess you can see the highlighting in red down there. It's only available if your payroll cycle is biweekly or more frequent. But the idea was that there was some acknowledgement that if, depending on where you happen to receive your loan, it could be very difficult and painstaking to provide documentation for the measurement period as it relates to payroll costs. So they just tried to create an alternative covered period for you that would hopefully get you to close to the same place in terms of your payroll costs, but make it easier from a documentation standpoint. I do think there may be some reason not to do the alternative covered period, because essentially what we found out in the guidance as well, and it was in the instructions, but it just wasn't all that clear. But any payroll costs paid during the 8-week period, as well as any payroll costs incurred and then paid at the next payroll date after the covered period, after the 8-week period, will be includable. So presumably you could get a few more payroll dollars squeezed into that 8-week period if you stick with your, and again, it depends on your specific circumstances and when you got the loan and when was your what's your payroll cycle. But that's really all we wanted to cover there. Is that's one of the first things you have to decide before you start filling out the application, is what's going to be your covered period for payroll costs.
Yeah, and as Paul, as you said, I think the interesting thing here is that because of the way they worded it, you can actually, as you suggested, capture more than 56 days of payroll in here. So you don't necessarily have to move to that alternative period, because if you got your loan on the 15th and then your first pay date, say was the 18th, 3 days later, well, that entire payroll can be included in there. So even though it wasn't really earned by anybody prior to the start of that period, and then at the end, you can go up to, as you suggested, any payroll earned or incurred, even if it's paid in the next payroll after that period. So
right. But admittedly, that's going to be more difficult to document.
Yeah, absolutely.
You have some work to do if you want to go that route. You have to determine if it's worth it to you.
Yeah. And Paul, this is
So
kind of what you were referring to, right?
yeah, and so this is the basis of accounting, another topic that we want to hit just before we kind of go into the actual form itself. But to the basis of accounting, and we did get very clear evidence on Friday that the basis of accounting is any costs paid during the 8-week period or incurred during the 8-week period, and then paid either at the next pay date or the invoice date for non-payroll costs. So I think what this effectively ruled out is any prepayment, right? If you haven't incurred a cost, but you decide you want to prepay it, they're not going to let you count that. But it does allow us, if you're in a situation where you hadn't paid something because of cash flow issues, you can get caught back up during this 8-week period. The example I like to use, because we get asked all the time, it's a very common question, is the retirement benefits example. And here clearly, if you have a qualified retirement plan in place and it allows you to do a profit sharing contribution, whether you do it on a regular basis or not every year, doesn't really matter. These are completely discretionary contributions. But the fact of the matter is your employees have earned, if you're going to declare a profit sharing contribution, they became entitled to that as of the end of 2019. So it is an incurred cost. Now you just need to decide when you want to pay it. So what we're telling folks is, hey, just under the current rules as we understand them now, this is good. We like this strategy if you are entertaining these thoughts. But to be conservative, wait until near the end of your 8-week period, because there is always a possibility, it's a fluid situation, always a possibility that they will say, no, we didn't mean a 2019 discretionary profit sharing contribution. They haven't come out and specifically said that that was okay. So I can envision a scenario in which they would say that's not okay. And the only reason I say that is because a lot of these discretionary profit sharing contributions can be allocated within all of the relevant rules that apply to profit sharing plans, but they can be skewed to the owners. And so if they were concerned that owners were getting a bigger bang for their buck than maybe the rank and file, that they might disallow that. So wait until the end of your 8-week period. It's the other reason I say is wait is it's hard. You create a lot of collateral issues if you try to take money out of a profit sharing plan. We're not going to get into all of them today, but suffice to say, it's good advice. You're not sure that you would otherwise, if you're going to make the contribution anyway, regardless of your PPP loan, go ahead and put the money in. But if the only reason you're doing it is to get that forgiveness, and otherwise you wouldn't make it, then I would say wait until the end. That's good conservative advice. That's a good example of something that we think is okay now.
Yeah, and this is your area of expertise, Paul. So I would take whatever Paul says and that's and follow that for sure. But and the other thing to remember here, as we talked about earlier, it's highly, highly likely that this 8-week period is going to be extended to either 16 or 24 weeks. So for those of you trying to game this to secure that 100% forgiveness, it's not going to be an issue. If that happens, which everybody says is a done deal. So we'll see. Where to start?
Where to start? Well, I just thought, we said the title of the program today was Navigating the Form, the application. So we ought to pay a little bit of lip service to kind of walking through, but neither Doug nor I really wanted to do a forced march line by line through the entire application. But so just some general words of advice if you haven't taken a deep dive look at this application yet. I think everything I've read out there, and it kind of jived with my intuition as well, as start at the back and work forward. So all the information that you're going to need for the actual application itself is built on information that comes up from Schedule A and from the Schedule A worksheet. So start with Schedule A worksheet, and then in order to work on the Schedule A worksheet, you're going to need to get your employee census organized. Again, this is something near and dear to my heart in the retirement plan industry. Everything we do is employee census driven in terms of plan design. So I'm very used to thinking in terms of getting employee census organized. But so you're gonna want to know, there's two different tables that you're going to have to complete. One for those employees that made less than 100,000, and then I've got in red there, annualized for any pay during 2019 or new employees in 2020. So you're going to put in there anybody that if they got a bonus or a big commission check or any type of special pay anytime in 2019, that if you took that amount and multiplied it by 26 or 52 or whatever their pay frequency is, and it's more than 100,000, then they're not going to be included there. So this is for those employees that if you annualize any of their pay, you would report them in that table. And then the other table is for anybody else, basically. And then something else that, and I don't know that this necessarily made it into our slide, but you are not going to put any owners anywhere on either one of these tables. That information gets reported on a different line. I think it's on Schedule A. Yeah, Schedule A of the application, line 9, I think. And the reason is, as far as I can tell, although I haven't read this, but just trying to look at their logic, is they're not going to let you count owners as in the FTE or the reduction calculations for forgiveness. So you're not going to put any owners on either one of these schedules. And then obviously you're going to want to determine which period you're going to use. You're going to use the 8-week period starting with your loan disbursement, or the alternative. That's for payroll costs only. And then you're going to have to figure out what's your reference period. And you're going to need to do the FTE calculation for your reference period as well as your 8-week period. So, but one nice thing is in terms of cash compensation, that we did get clarification on Friday that may include a bonus or hazard pay. I can't tell you how many times we've gotten that question. Is it okay if I pay more? I know I can't pay less, but can I pay my employees more? And what we've been telling clients is yes, we don't see anything wrong with that scenario. It does seem to be in the spirit of the law. And with the one caveat, make sure you don't exceed 15,385.
Well,
which is 100,000 on a prorated basis.
And the key there, we get this one a lot too, is that you can pay them more than that. It's just that's the cap for forgiveness. Right. So we've gotten that one a few times. Folks think, oh, that's a cap on my pay. No, it's not. You can pay them a heck of a lot more than that if you so choose. It's just that's the maximum that counts towards forgiveness. So, all right. Third poll question. Curious to see what folks are thinking here. Again, I think there was a lot more dialogue around this. So this is, obviously, have you considered paying one-time bonuses or making a 2019 discretionary profit sharing contribution during your 8-week period? I think early on, the answer to this would have been yes, a lot more, but it's particularly now if we get the 8-week period extended, I don't think this matters as much, but it certainly can for folks. So we'll see. And obviously there's always a chance that the 8-week period doesn't get extended. So then this does become more important again.
Yep. I think we just wanted to give the group who's attending today just some idea of what their peers are thinking.
Yeah, absolutely. Absolutely.
It looks like 64% said yes and 36% said no.
That's more than I thought. That's surprising.
Yeah, 2/3, 1/3.
I will say that everybody that I talk, I shouldn't say everybody. Should never talk in absolutes. Most people that I talk to really want to get 100% forgiveness if they can, and they really, as long as it's not crazy, out of this world expensive, they don't mind the idea of paying some bonuses or doing a discretionary profit sharing contribution.
Well, and it is a good way to reward your employees through this difficult time as well. Certainly that's warranted.
Well, and what I've told clients too is, hey, if this thing gets extended out in terms of the economy getting restarted and it lasts a lot longer, this economic downturn, and you end up having to lay folks off, even though you didn't think so initially, or this 8-week PPP loan program has kind of delayed that decision. The fact that you've given them some extra money now is just going to help them, in the event that they are laid off. So it's definitely within the spirit of the program. And I think a lot of our clients acknowledge that, and they like that.
So Schedule A worksheet, as you get into the meat of this thing, just a reminder for those that haven't seen, there was a lot of thought. In fact, I would tell you this was our thought too, that an FTE would be 30 hours per week as it is defined under the Affordable Care Act. However, that was not the determination that was finally made. They did use a 40-hour week. And I know I've seen there was some discussion even from Secretary Mnuchin that said they strongly considered the 30-hour week, but ultimately decided to go.
It just occurred to me, Doug, we should have seen this one coming, right? I mean,
yeah.
Trump has been negative on Obamacare and still is. So he's trying to reverse everything that's associated with it. So this is probably exactly where we should have guessed we'd end up. But
probably.
We didn't see this one coming. We just thought path of least resistance would be 30, but not so. We'll go 40.
And again, as you calculate this, reminder that the maximum any individual can be is 1.0. You can't be greater, even if you average more than 40. And then you're at a fraction of that, depending on your average hours per week that were worked during the covered period, if you're under 40. And again, there is an alternative calculation. If you don't want to go through all the math with regard to this, you can just say, well, a full-time is 1.0, and anybody who averaged less than 40 counts as a half an employee, basically. So they did try to make it a little bit easier if you don't want to do all the math here.
I did have a question come up this week regarding this calculation, and I don't know that it's necessarily specifically addressed, but I think in terms of just following the instructions and the guidance that we have is probably the best policy, and that is, what happens if I've got somebody that normally works 40 hours a week or more, most weeks, but then for whatever reason worked less than 40 for some period during my measurement period or my reference period? Do I need to take that into consideration? I think the answer is yes. You basically take the average hours worked for the entire, for each payroll period in whatever period you're measuring, and then divide that by 40, and whatever number you come out with, But you don't really make a predetermination. Now, those that are on salary, I think it's more obvious. You're not really counting hours for them. So if you paid them their salary, there's the assumption that they worked the 40 hours. But for hourly folks, you're really going to need to look and count each payroll in the covered period and add up the hours and then divide by 40 to come up with your.
Right. And we see this a lot with contractors for sure because of the weather. Obviously, last week, for example, a lot of folks couldn't get those full hours in. Now, again, you can make those up in subsequent weeks here. The key is the average over the entire 8-week covered period.
I think so. Yep.
So FTE calc, I know there was a lot of questions about this early on. If you have folks that essentially are no longer with your business for reasons other than the coronavirus, make sure, as we had earlier in the documentation piece, make sure you document all of that stuff. There's a lot of exceptions here that you can pull out of your FTE calc, but again, documentation is critical with this stuff.
Right. I think the way the instructions read is you actually include these in your FTE count. So you basically get credit for having these people. In other words, you don't get dinged.
Don't get pat. Yeah.
Gone. Right.
Yep.
Unless, and then the exception there is at the bottom. If the position was filled with another person, then obviously you don't get to double dip. You don't get to add back in the person that you fired and their replacement. I think that just makes common sense. But essentially, the way the form works is you get to include these folks as FTEs so that you're not penalized for their absence.
Yeah, my fault. I should have clarified that. The idea is you're not penalized for
Right.
these folks. Exactly.
Right.
Which is the way it should be, because these are other reasons.
Right. Right.
This one, Paul, do you want to talk about this a little bit? Because
Well,
there's
I thought this was, I thought this was going to be a doozy of a calculation and
right.
documentation. I mean, I was sweating when it came to this one. It just,
Yeah.
I had to read and reread. I was looking for other commentators' thoughts and ideas in terms of what they meant here.
Yeah.
I think what they want you to do is they want you to annualize. Well, I think the thinking has definitely evolved. For one thing, I'll say that up front in terms of the government's position on this. But I think what they were originally thinking was, we want you to annualize their rate of pay during the reference period and their rate of pay, or their average pay. I'll say that their average pay during the reference period and their average pay during the covered period, and you're going to compare those two. But you have to take that and you have to annualize it back, and then you have to take the difference between the one average and the other average. It was it was going to be a heck of a calculation. I think where we ended up, thank goodness, I think where we ended up is the government wants you to focus on just the rate of pay. And so I don't know this for a fact, but I would venture to guess that most companies, when they start trying to control payroll, they don't start messing around with rates of pay, unless they were trying to do some sort of job sharing or something like that. But I think most of them dealt with a reduction of hours first before jumping onto the rate side of things. So if you didn't adjust rates at all, then I don't think you need to be concerned about this at all. This is not going to apply to you, because it's very clear from the guidance that if your rate of pay during your reference period, which is Q1 basically, compared to your covered period, is the same for these folks, then you're not going to have any reduction here at all. And I think with a little bit of planning, as long as you bring folks back and make sure that if you did reduce anybody, those reductions are back to, and you'll have to document that through a payroll that you actually paid, I suspect. But as long as you can document that they're back to where they were pre-coronavirus, then you're not going to have any reduction, or you'll meet the safe harbor. So one way or the other, whether you never had a reduction and therefore it doesn't apply to you, or you meet the safe harbor, either way you're going to avoid having a reduction for this. So I'm a lot more confident now that this reduction is not going to apply in most situations. You agree with that?
Yeah, I agree. I think they made this provision, as you said early on. We were concerned, gosh, there's so many different ways you can interpret how you calculate this thing, but this provision specifically now I think is fairly simple based on the rate of pay. Getting to that safe harbor, that June 30th date, there was a lot of questions about that too. Well, if you restore your FTE by that date, or if you restore the pay by that date, what are they looking at? Is it just that day in time? Well, as of now, that's where we stand with this. So if you've got that documented, when you get to that point, if you have had a reduction in force, and you're concerned about your FTE numbers, or you've had some pay rate reduction and other things, if you restore those by that date, and that is a one date in time, you should be okay on that as it stands now. Again, caveat is it can always change.
Yeah, and the logic there was they didn't want to double penalize companies that were getting dinged in the FTE reduction, and then because the number of hours is included in the calculation for how much you pay somebody, that you get a ding on that side too. So somebody a lot smarter than I was obviously pointed that out to them. So they basically said, okay, take hours out of the equation. Let's just focus on the rate.
Yeah,
I think makes it a lot more understandable.
Yeah, this obviously fairly self-explanatory as you get into the Schedule A.
Yeah, once you've got all this information kind of pulled together on the Schedule A worksheet, it begins to then kind of flow from one work paper, one application to the next.
Yep.
So Schedule A, the purpose is just to calculate total payroll costs. It'll flow onto your application. And then I mentioned line 9 before. That's for self-employed independent contractors or partners only. Now I'm saying no owners of C Corps or S Corps. I am going to retract that now, Doug.
Yes.
Learning as we go. I had some colleagues challenge me on that this morning, and I totally agree that based on the latest guidance, I was there's the term in there that they use called owner employees now, and I was in my mind that was the equivalent of a sole proprietor or self-employed individual. So now I am of the opinion that line 9 is for any shareholder employees in a C Corp or an S Corp, as well as all of the others that I said there. They're all going to go on that line 9. And frankly, I forgot I had this line in my slides. Otherwise, I would have fixed it before today. But for sure. And I think what they were getting at there was they wanted to carve them out of that FTE calculation.
Right. Well, and I think the other thing, to be honest,
they want to treat people fairly, right?
Yeah.
It doesn't make any difference what entity you owned. They want to treat the owners fairly. So, but go ahead, Doug.
No, I think the other thing too is there'll be some measurement of this data as it comes out in subsequent years or months afterwards, and there will be a lot of parsing of that data around. Did the owners of all these loan recipients just give themselves a bunch of extra comp and raises? So that's something to watch out for as well. I think that's part of this also. It's kind of this no raise doctrine that started back with the TARP funds and is carried through to many of the loan programs. So
right. So you're going to report any compensation for self-employed independent contractors or partners and owners of C Corps and S Corps on line 9. And I don't know that we necessarily get into it, but in terms of how you calculate those dollar amounts, I think we should probably spend a little bit of time on that, Doug. It's the lesser of your 2019 compensation as an owner, whether it's a wage or whether it's net self-employment earnings, as an independent contractor, sole proprietor, partner, or $100,000 or $15,385 for the period. So it's the lesser of those two. So I think until we got that guidance Friday, we thought that there was kind of an unintended benefit, if you will, for shareholders of C Corps and S Corps that were employees, but they kind of took that away from us.
Yep. So again, this is where, if you get into, once you've got all your data and all your numbers pulled together, kind of the flow for it. And again, it is our understanding, again, having talked to several bank execs, there will be an online process for this because, again, the banks have to go through and sort of make sure that the calculations are correct. So if it's done through this type of process, there's, they take that sort of manual part of it out of everybody's hands, and it'll self-calculate and check. Some things to point out here, though, is still, we had thought initially that related to mortgage interest, we were going to be focused strictly on real property. It still includes personal property at this point. Again, the only thing as we see it that would be excluded here is if you've got unsecured debt, obviously would not apply, or if there's something specific, perhaps you have a revolving credit facility that's only perhaps secured by some other collateral that's not real or personal property, things like that. But it's much more of a wide berth here, I think, than at least I anticipated. Self-rental, we get that one a lot as well. That is okay, but again, be reasonable and consistent as we outline here. Hopefully you have a lease in place that prior to February 15th, 2020. If so, follow that lease. If you did not have a lease in place and it's related party rental, we see this frequently, make sure you're consistently following what you paid in the past. Don't go jacking up the rent here. again, adhere to the spirit of the program. Paul, you want to touch on anything else here? Transportation? I know we get that one a lot.
Yeah, I think people want to know, are cell phones and internet included? I would say yes, both of those. That's pretty clear. The one thing that's, I think, a bit of a mystery still is transportation. The only example, I think we talked about it before, the only example we've been given by SBA is gas for business vehicles. And that was given in the example of a sole proprietor. So presumably that applies to everybody. But that's the only example we've been giving. So I'm not sure what else would fit under the category of transportation at this point. But so no new developments there, really.
I heard one last week, helium. I was on a legal, like I said, a large law firm's.
Yeah, I saw that. Where did that come from?
Somebody who is in the hot air balloon business wanted to use helium for transportation costs, and so that's unusual, but I guess you can see everything if you think about it.
Transportation by hot air balloon.
Yeah, there you go. Again, just any further comments on this, Paul?
No, but I mean, just kind of following through on the forgiveness application, line 5 is where you're going to have your adjustment. And this just kind of gets to, we were all wondering in what order were we going to take these reductions.
Yeah,
so
good point.
Line 5 is the adjustment for the wage rate reduction, if any. Again, I'm saying I think there's a lower frequency of this being on. I think this is going to be a 0 for many employers. So then there's forgiveness amount. So and then after that, you have your reduction for the FTEs, I guess. And so that's what I was getting at there with the forgiveness amount is reduced for this factor before the reduction for FTE on line 7. And then lines 9, 10, and 11, you're going to take the lesser of those to figure out what your actual forgiveness amount is. And it's on line 10 where they kind of bake in that the 75% requirement for payroll costs. And so you can infer from that. There was a lot of concern prior to the application coming out and the subsequent guidance that there was a requirement that there was concern, I guess. Some uncertainty that if you didn't hit 75% of your loan amount and payroll costs, that none of it would be forgiven. Well, that's gone away because what they're really saying, and this is the way I interpret it from the beginning, but it really depended on what provision and what guidance you were reading. I mean, it really was confusing. But it seems most common sense to me that they meant to have a kind of a sliding scale in terms of forgiveness, and they weren't going to come in and hammer you if you didn't hit the minimum 75% on payroll costs compared to your loan amount. So what they mean is 75% of whatever your reduction amount is, or your forgiveness amount. Forgiveness amount has to be payroll costs. So you can obviously have a forgiveness amount that's less than your loan amount, and only 75% of that forgiveness amount needs to be payroll costs, or they're going to limit you, and they do that by that 75% calculation there.
Yeah. In other words, it's not the zero-sum game that we thought, some were concerned about where, oh my gosh, if I don't hit this threshold, I'm thrown out. It's not the case. So.
Yep. I think the rest of that application is pretty self-explanatory.
We got just a couple more slides here, and we're going to get into a lot of time for Q&A as well. But one last poll question. Would it be helpful if in your situation, if Congress were to relax the requirement that payroll costs be at least 75% of the total forgiveness amount? I'm kind of curious on this one, what the weighting is with our audience with regard to, quote unquote, overhead costs versus labor and payroll cost. My suspicion is there's a fair amount that obviously that are more payroll heavy, and maybe it's not as big a deal, but still, there's a lot of businesses that are more certainly overhead heavy and have a lot of fixed costs outside of payroll, and it's certainly relaxing this provision would benefit them.
Well, I just know that there have been a number of industry lobbies out there that really, particularly the restaurant and hospitality lobby, that's really been pushing for a relaxation of this.
Yep.
Looks like 45% said yes and 55% said no.
Interesting. So, yeah. So
I would have thought more yes than no.
I would have thought it as well, but yeah. Anyway, this one, this is our final slide, I believe, before we get to Q&A, Paul. But a lot of stuff came out in the IFR that was, again, in the dump last Friday. Some of the things to highlight out here, again, the banks are going to confirm those calculations on the application. That's why I know one of the reasons they're really pushing to get this online process going, because otherwise they don't want to go through and do all that manually. If you think about the volume of applications that were done here, and confirming all that documentation is attached. That'll be, again, as we talked about earlier, that's the tricky part, because it's going to be just so much stuff, and it's going to be so different for each borrower potentially.
Yeah, and I think banks aren't used to dealing, well, maybe they are, I don't know, but I think CPA firms are probably more used to dealing with audit evidence, audit documentation. And so qualitatively looking at what might be a good piece of documentation to back up a number versus one that's not so good. It'll be interesting to see. It's probably going to be institution by institution in terms of how strict they are and what kind of a standard they decide to use. I don't know. You have any thoughts on that? You're the former banker, Doug.
Yeah, I mean, it's certainly the banks aren't. It's not typical where they're getting all of these, kind of payroll records and all those things. Some of the stuff, yeah, it's very standard where they're getting copies of leases, things like that. So some of that, I think, going to be much easier systematically for them to handle. Again, I worry about the volume of some of this stuff, like I said, with the different payroll records. If I'm looking at utility payments, things like that, how's that? It'll be interesting to see how the online process works, but I know they're going to do their darndest to streamline that as much as possible. And
I am certain that if
they're successful.
Yeah, I'm certain if you use a well-known payroll processor, they will have a deep sigh of relief, because I think there's the SBA even in their guidance tells lenders that obviously you don't need to do as much review on something that comes from ADP or Paychecks as you do on something that is maybe somebody's doing payroll in-house and they're creating their own reports. So I'm sure they'll be glad when the standardized reports show up from national payroll providers. But if you're not using one of them, then you just have to make sure that your documentation is easy to follow.
Yeah.
That way.
Absolutely. Best to work with your bank and your CPA firm if you need to coordinate all that and get everybody on the same page. I think this last one is interesting here, Paul, and we've already seen this actually in a couple of cases I know of where it was such a hurried process initially that there were some errors in what was done in the application, and they got through. The bank didn't do anything about them. Perhaps 1099 folks were included and they shouldn't have been, or a number of different things. And I know in these cases, the borrowers have already worked with the banks to correct that situation. In essence, make a partial pay down related to any error that resulted in additional advances and things like that. So really a pretty easy fix. It's not something somebody should be overly concerned about, as long as you, again, are being a good actor, I would say, and adhering to the spirit of the law, and you didn't, obviously knowingly commit any type of fraud. I think if it's an honest mistake, you can easily correct it, no problems.
And I think from the audience's perspective today, it's worth noting that the SBA has basically told lenders, hey, you need to know, they understand that it's a big documentation project that they're asking here, and that lenders should help help their clients or their customers work through this so that they're in compliance as best as possible. But it is important that you get all that in there, because the SBA does reserve the right to come in and look at any loan that they want to look at. They don't really need to have a specific reason why. So.
Right. Well, with that, Paul, do you have any additional comments before we get to the Q&A? Q&A is always most fun for me. We get a lot of good stuff in that. We've allotted some extra time today for that.
I don't think so. I think let's get into the Q&A. Hopefully we have more time today than we have in the past.
Yep. All right, Imani, you want to hit us with Q&A?
All right. So the first question we have here is we actually have a lot of people asking about what you mean when you say owner's pay is not included in the forgiveness provision. Could you go over this again to provide everyone with additional clarity?
Yes. Yeah. And I apologize, because I'm probably the reason for all of that confusion. So what we're saying is that the owner doesn't get listed on Schedule A worksheet on those tables back there. That compensation gets included on line 9 of Schedule A. So it is included in the forgiveness calculation, right? If anything I said made it sound like owner's comp wasn't going to be included, that is unintentional by me. And clearly, owner's comp, regardless of what type of entity you are, independent contractor, sole proprietor, partner, C Corp, S Corp, all of them can include their comp. Now, how you calculate that comp for owners, and I'll go over that one last time, again, trying to eliminate any confusion. For everybody now, for every owner of any type of entity, you're going to be looking at the lesser of their 2019 compensation, whether that was calculated on a Schedule C or on a K1 or on a W2. You're going to be looking at the 2019 compensation or $100,000, whichever is lesser, and that's what you're limited to in the 8-week period.
Yep.
Did I say that right, Doug?
Yeah, prorated to that 15,385 max.
Exactly. So the max is 15,385, but you got to make sure. So, for example, if an owner, for whatever reason, only paid themselves, let's say in an S Corp situation, $60,000 last year, they're going to be limited to $60,000. Okay.
Yep. Yeah, you can't give yourself. Again, it's adhere to the spirit of law. Don't give yourself a big raise and expect that that's.
And that is a change, as I mentioned before. The guidance that we got on Friday made that tweak, and all they did was really independent contractors, sole proprietors, partners were already in that boat. It just kind of threw S Corp and C Corp shareholder or employee owners, the shareholder owners, whatever you want to call them, into the same boat.
Yep. But that comp, again, that comp does count towards forgiveness. It's just that there's some, it's broken out separately from the rest of the employees.
Correct.
So hopefully that's clear.
Great question. Because that's been a really confusing piece of information.
Yeah. What's next, Imani?
Did we lose Imani?
We might have. Hopefully we've got more.
Come back,
It
Imani.
looks like we did for a minute. This is Abby. I'm going to jump in real quick. And the next question we have is, for payroll documentation, may you use a QuickBooks payroll summary accompanied by copies of canceled checks?
What do you think with that one, Paul? Well, it's QuickBooks summary copy. Yeah, if you've got the checks, yeah, that's good. You can do that. 941s, obviously, too. All that related documentation.
They're going to want to see documentation of the payment being made, whether that's ACH, do you direct deposit your employees, or do you write physical payroll checks still?
Yeah.
They want to see documentation of that, and then obviously documentation of how you calculated that payroll. So from your payroll register.
But yeah, if you've got the copies of those checks, plus you're going to have your bank account statements, that's going to be a key part of it too. So they can see, the other side of that stuff being dispersed and everything. So, but yeah, that should be sufficient.
Great. Can rent or other costs, including health insurance, fit the model for forgiveness over and above the 8-week period based on the rules clarification?
Yes, it can. Again, this is this sort of hybrid cash accrual method that we've got there. So if it was paid during the 8-week period, that counts, and anything that's incurred up through the end of your 8-week period, as long as it's paid at its next regular date. Again, is that your understanding, Paul? Again, no prepayments. Don't think you're going to prepay a bunch of stuff. Try to.
Yeah, interestingly enough, the only place where they say no prepayments is for mortgage interest. But I would not be comfortable, and I haven't been recommending to clients to prepay rent or anything else. If it was incurred prior to the 8-week period, but you just happen to pay it during the 8-week period, I think that's good. And then if it was incurred, but you just hadn't gotten to the point where you needed to pay that bill yet during the 8-week period, as long as you pay it at the next invoice due date, you should be fine. But I wouldn't try to prepay any rent or mortgage, and certainly not mortgage interest. It specifically says not to.
Right. But there again, when you're looking at rent or something like that, and say your 8-week covered measurement period ends June 15th, I think it's fair to pay, any of that say would be for June 1st through June 15th, or fair to include that, I should say, even though it's not yet paid, as long as you pay it on your next regularly scheduled disbursement schedule. I think that
Right.
kind of thing is fine.
Right. And remember, for non-payroll costs in particular, since that's what the question was about, you're always going to be tempered a little bit in terms of how much you can take advantage anyway, because you're going to be limited to 25% of your total forgiveness as non-payroll costs. So I'm just throwing that out there. Just kind of keep that in the back of your mind.
Yeah, absolutely. What's next, Abby?
All right, my connection came back, so I'm back on.
Oh.
It says, we are a construction company and have had some employees have over 30 hours, but under 40 due to weather. Now with the 40-hour rule, can we make up payroll to cover the hours?
My suspicion is, yeah, because you're looking at that average over the 8-week covered measurement period. So, if they were averaging under 40, say for the first couple of weeks, as long as you get them up to a 40-hour average over the 8-week covered measurement period, I think you're okay with that. What do you think, Paul?
I would agree. I think it's a little bit of a gray area. And I haven't seen a specific calculation. They do talk about the average over the payroll, the average number of hours over the payroll period. So what you just described. So I would agree with that.
Yeah.
Point.
Okay, the next question we have here, it says, you referred to the under 2 million means de facto recognized as necessary. What are you guys referring to?
So that's the certification that everybody was concerned about that initially came out, I believe, April 30th, that, the documenting that your thought process that this was deemed necessary for your business. There was a lot of concern around that word necessary. What does that mean? And the threat of, jail time and all these other things. Well, that's gone away. They essentially said any loan, that PPP loan that was less than 2 million, you're de facto determined to have met that certification that it was necessary. It doesn't mean that you can't be audited. You still can be audited. It's just that they're not going to sort of hammer you for saying, well, this loan really wasn't necessary for your business. You got anything else to add on that?
Oh, yeah, well, just the site in terms of the guidance that came out in an FAQ, and I just pulled it up to make sure I'm right on this, but it was FAQ 46 that came out. What date did you throw out?
Well, April 30th was the original.
Question, yeah, FAQ 46 came out May 13th.
Yeah, it's a couple weeks later. Well, April 30th was the original date when Mnuchin said, we're really gonna.
Oh, yeah.
Yeah, and then it was a couple weeks later when they clarified.
So it's FAQ 46. That's your guidance. That's your citation for what we're relying on there in terms of the certification. And I think once that came out, everybody took a big sigh of relief, because then they didn't have to really worry about it. I mean,
yeah, I don't think it's a big deal.
Does it make sense for us to read through it? I mean, I'm happy to read through.
I don't think it's a big deal, because at the end of the day, if your loan's over 2 million and they determine that you weren't, it wasn't necessary for your business, the worst thing that's going to happen to you is that you're going to have to pay it back.
Right.
So
right.
it's
no criminal penalties, right?
And again, it's about documenting all these things we talk about. Build that file, build that case. There were so many unknowns to either your customers, your contracts, your supply chain, all these types of things. And it's not just the short-term impact, it's longer-term impact. You can go back to what happened to your business in the last recession in 08, 09 timeframe. Go back to some of that. Throw some of those references, maybe some of the financial impact that you had during that time into your file as well. Because again, that builds the case and your thought process of, gosh, we were really concerned here, and that's why we applied, and that's what it was, all in good faith, and that's what we did.
Okay, so we've also received a lot of questions about various forms of non-payroll costs and whether or not they will be forgiven. Will fuel, cell phones, uniforms, security systems, etc., be forgiven?
I'll take a stab at that one. I would say, we talked about that quite a bit as we went through our slides. I would say they're going to be pretty strict when it comes to that, as opposed to less strict, I guess.
Right.
So when it lists out the utilities that qualify, if what you're asking about isn't internet, or isn't your cell phone bill, or your electric bill, or your gas bill, I would say you're on maybe shaky ground. I'm having trouble thinking. Read through that list again.
She mentioned like uniforms, I know, stuff like, I would.
Yeah, I don't think so.
Yeah, so uniforms, cell phones, fuel, security systems.
No, security system, not. Yeah, that. Utilities are something everybody has, and I realize security systems are common, but it's not something you have to do business, right? I mean,
right.
You could make a business argument that you would, but to turn the lights on and to start a business, you don't need a security system like you would need electricity, for example.
Right.
So anyway,
I would agree with you.
Try to focus on what is a true utility. What's a kind of like water. You can't exist without water. You can't exist, and you can't have a business without a phone. You can't have a business these days without internet, electricity, gas, whatever. So
right.
Hopefully that's helpful, but I would try to stick as close as possible to the definitions provided. I think where you do have some additional wiggle room, if you want to call it that, is in the personal property areas, right, on the leases and on the mortgage interest.
Yep. So. For sure.
Okay. So the next question we have here is, if you can show a 25-year history of a monthly paycheck to S Corp owners, does the 852 rule still apply, or can you submit 2 pay periods?
Did you catch that, Doug? I almost
I'm not sure. If you got a 25-year history, it doesn't matter. I mean, you're limited to 850 seconds of what was paid in 2019. So if all of a sudden you had 25 years of doing something and you didn't do it in 2019, that timing wasn't good. That's all I can say with that.
Yeah, I don't. Doesn't come close to complying in my estimation.
So the next question we have here is, do you believe that if the number of weeks get increased by the government, that the compensation limit of $15,385 will go up proportionally? That would help with the forgiveness.
Yes, it'll be pro rata for $100,000.
That would make common sense. Now, this is the government we're talking about. So, but yes, I think that's a reasonable assumption.
Yes.
Next question we have here is, for payroll documentation, may you use a QuickBooks payroll summary accompanied by copies of canceled checks?
Yep, we already addressed that one.
Okay. Let's see here. We have if compensation cap for loan forgiveness is based on annualized amount on any pay, then wouldn't a way to bonus comp and the amount, I'm going to skip that one and we're going to come back. If a salaried employee voluntarily requested to take a leave of absence during the measurement period, how would you suggest we document that it was not a wage reduction or FTE reduction? Is written communication regarding the requested days off sufficient?
That's more an HR and certainly legal issue, but yeah, I would do everything you can to document that. I think if you do so appropriately, if you document the conversations that were had via email or a phone conversation, take some notes and minutes, make sure it's signed and dated according to your appropriate HR policies, that somebody requested a leave of absence for whatever reason. Document that. Now, if it's related to the Families First, the FFCRA, that's different. Those are different. You have anything to add there, Paul?
No, only that the only thing I was going to say was if you haven't documented anything in writing, which, as you indicated, could include email, then I would just go ahead and confirm with those individuals that we did discuss this and you did volunteer to do this, and just to get it in writing. It's because it does have to be documented.
Yep, signed and dated if possible.
Yeah, if it's not documented, it didn't happen. So.
Right.
So this one here says, we had to furlough employees on March 17th. We are bringing them back 2 weeks before our loan ends. Will this fall under the safe harbor calculation on the application?
Well, yeah, if they're there June 30th, you're
Exactly.
You're going to meet that safe harbor requirement. Now, the tough part will be getting, spending enough of that money on payroll to get the loan forgiven. But again, that's where a business like
that is a great example. Yeah, it's a great example, Doug, of where an additional 8 weeks, right, would really help. Additional 4 weeks, 8 weeks, whatever, would really help that. And that's the reason why certain industries have been so adamant that they need more time, because they can't possibly. Yeah, they can get them back on payroll, but it doesn't no good because they haven't been paying these folks anywhere near what they were paying them, last year, which is what their loan was based on, the payroll from last year. So there's no way they're going to be able to use up, get significant forgiveness. So that's a great example of where additional time would really help that company.
Yeah, but yes, they do meet the safe harbor for any of those other knockouts, so to speak. They're on there by June.
So the next question here is, what are your thoughts on tips for salary reduction? Would you include tips in the calculation? Tips are way down at the restaurant in this scenario.
Yeah, I know there's been, we do have wish we had Matt Long on for this one, but you're supposed to make a good faith effort in estimating those tips during your measurement period that you're using, your baseline measurement period, whichever one you choose, and also your 8-week covered measurement period. Now, what that good faith effort is to document that, because obviously a lot of those are cash tips. So whatever is reported, hopefully you've got some decent records and you can track that. But yes, you are supposed to make a good faith effort with regard to those cash tips, and that is included in the pay and ultimately is a part of that pay rate calculation. You have anything else, Paul, on that one?
I don't, but I agree with you that part of your good faith effort to estimate those is you can fall back on what are they typically for your restaurant, right? I got to believe that they're consistent over time in terms of the type of restaurant you are and the clientele that you're serving. And are you breakfast or are you dinner? A lot of different variables there, but in terms of what percentage of somebody's hourly rate is tips, it's going to vary by institution. But somehow you have to come up with a way to estimate that. But I'm not a restaurant expert either. So
I think the hard part is it was suggested in the question, you're not making those now. So, if you're a restaurant owner, do you choose to make that up with some increased base rate pay during this time? Or again, that's where your hazard pay or bonus pay can come in to try to help bridge that gap if your goal is forgiveness until you can be fully open and they can earn tips at the same rate, but not an easy one to solve.
Okay, the next question we have here is the application doesn't include what the SE individual without payroll is to submit for verification of the income. Do you know what they will be requesting?
did you say the individual with SE income?
Yeah, I think they're referring to self-employed. Yeah.
Yeah, so that's pretty, yeah, the only thing that you can, two things. You're going to want, if you haven't already, you're going to want to include in your file, in your documentation, the Schedule C or K1 in terms of how that net profit from self-employment was calculated and reported in 2019. Or if it's more than 100,000, then you're going to be limited to 100,000. And then you're going to want to show specifically some draws during the 8-week period, right? Some payments made. Right. I think if you do those two things, then you're fine. Do you agree with that, Doug?
Yeah, and that's where, again, you can bank statements, things like that show the disbursement of those funds based on what you applied for and received. So if your Schedule C showed 100,000, again, you're limited to the 15 through 85. So if there's some way to document those disbursements during that period, that's your quote unquote pay.
The next question we have here is when calculating full-time employees, can you explain how this is calculated? Not all companies calculate FTEs as 40 hours per week. For example, what if an employee works 37.5 hours each week?
I think you have an opportunity there.
You have what, Paul? I'm sorry.
I think there's an opportunity there because they basically said there's that safe harbor that says if you work less than 40 hours, then you can go with 0.5 for those individuals, right? If you're
right.
Not 1, you're 0.5. I mean, you might want to play around with that alternative.
Exactly. I think what you're referring to is that essentially they didn't count as an FTE.
Right.
I don't know. I mean, but you have to be consistent is what I would say and adhere to the spirit of law. So 40 hours isn't full time for you, your company. Be consistent in how you approach and apply that. So if somebody was averaging 37 hours a week in your baseline period, and then they're 37 hours during your 8-week cover measurement period, you're fine. Don't try and game it so that you're playing with one end or the other to your advantage. Just be consistent there.
Next question we have here is, we are owners of a C Corp in the tables and also on line 9.
I'm sorry, you cut out there in the middle.
Yeah, I only caught half of that one, Monty. Sorry.
No problem. It says we are owners of a C Corp. We are also on payroll. So do we list our payroll in the tables and also on line 9?
No. Yeah, you don't list yourself. You don't list owners on the tables on Schedule A worksheet, but you do include your compensation as limited on line 9.
Yep, only line 9.
Next question we have here is, how much of a percentage does someone have to own to be considered an owner?
I don't think we don't have any guidance on that. So if you have any ownership, you would be considered an owner.
Right.
And no, we don't really have anything in terms of attribution at this point.
No, there was affiliation rules were different up front. That's different than this. I think anybody who's an owner.
Right. So if it's just if one spouse owns 100%, but the other spouse works in the business, at this point, I don't think we have any guidance that would suggest you include the spouses. or any other family members through some sort of attribution of that ownership.
Right.
You would just include the one owner at 100%. And on the flip side, if you have somebody that owns 0.5% of a business and still gets paid, they are an owner employee. There's no de minimis rule out there. So you would report them as an owner.
Right.
All right. Well, that is the last question for you guys today. We did hit time. They will be sure to reach out to you all with any responses to the questions that we didn't get answered. So thank you for joining us for today's live broadcast, What is Life After Coronavirus, working through the PPP Loan Forgiveness Application. We hope today's team was able to provide you with some valuable insight that will help you secure the funding you need amid this economic uncertainty. If you sign up today and realize that you have additional questions, you're always welcome to reach out to Paul or Doug directly. You can also contact any of our Rea team members by checking out the People section of the firm's website at www.reacpa.com. That's REA. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webcast, and more. Thank you, and we hope you guys have a wonderful rest of your day.
Thanks, everybody.
Thanks, everybody.